Okay, let's go ahead and take a look at Chapter 2. And we're going to pick up, obviously, where we left off on Chapter 1. And we're going to start to get into more detail as to the structure of the government-wide financial statements and the fund financial statements. And we're literally going to go ahead and take a look at what the financial statements look like, both government-wide and fund financial statements, understand how those are put together and understand some unique aspects related to governmental accounting related to those. And then towards the end of the discussion, we're going to spend a little bit of time just actually reviewing some of the activity of our various funds, our governmental funds, our proprietary funds, and our fiduciary funds. So let's just go over and take a look at the next slide, and you can see that we have our government-wide statements that we talked about in Chapter 1, and they report information about the net position of the government and the change in net position. Now, when we talk about the net position, we are, of course, talking about the balance sheet, and when we talk about the change in net position, we are talking about the income statement. Now, we don't call the income statement, we call it the statement of activities in our governmental accounting. When we talk about the change in net position, you can think of that as net income. We also have our fund financial statements, which give more detailed information about this government. And we're going to see that we've talked about how the fund financial statements talk about the various activity and making sure that money is spent for its intended purpose. But it is going to provide us more detailed information when we get to those fund financial statements. Going ahead and taking a look at the next slide, remember we said that for the government-wide statements, our focus is going to be operational accountability. We will be focusing on our economic resources, and we will be using full accrual basis of accounting. And remember, we talked about that in Chapter 1, that accrual basis of accounting is, of course, like our commercial accounting. When we talk about the fund financial statements, and again, we talked about these in our first chapter, we're going to, again, be making sure that we are spending our funds for the intended purpose. And we gave the example of using gas tax for road improvement in our last discussion. And again, these fund financial statements are providing more detail. And actually, they're talking about more detail in Chapter 2. We're in Chapter 2 now, and we're going to be learning more about these. And they do provide additional detail about this government. When we talk about our governmental funds, remember we said that we have a fiscal accountability focus. So when we're at the government-wide level, we have operational accountability focus. When we're at the individual fund level, we have a fiscal accountability focus. We are looking at the current financial resources measurement focus. Remember we said in Chapter 1 that if we purchased a long-term asset like a piece of equipment, we would literally debit expenditure and credit cash, so assuming we were paying cash for that purchase, and we would not carry those fixed assets on our balance sheet. So our expenditure literally shows up on our income statement, even if that item was for a long-term purpose. And again, I call it income statement here for short. We would call that statement of revenues, expenditures, and changes in fund balance. And we're going to look more carefully at that statement here in a little while. When we get into the governmental funds, we're going to use basis of accounting, modified accrual basis. So fiscal accountability for all of our funds. When we get to the governmental funds, we use our current financial resources measurement focus, and we're going to use modified accrual accounting. Of course, we will also have our proprietary funds and our fiduciary funds. Remember, we talked about 3 categories of funds, even though there's 11 different funds, 3 categories. And when we're in our proprietary funds or fiduciary funds, since we're at the fund level, we will still have our focus of fiscal accountability. But now for these 2 categories of funds, our proprietary funds and our fiduciary funds, we will use full accrual accounting, just like we do at the government-wide level, and we will have the economic resources measurement focus. So let's just go ahead and take a look at a little bit of a summary here, and you can see that we have all the 3 categories that we've been talking about: governmental funds, proprietary funds, fiduciary funds. And then you can see that we have listed each one of the fund types here. We have our general, under our fund types, each of the actual funds, we have our general fund, our special revenue fund, debt service fund, capital project fund, permanent fund. Okay. And note that we've given you the mnemonic, remember we talked about last time, GRASP. And then you have your proprietary funds, which are your internal service fund and your enterprise fund. And we're spelling the mnemonic CPAPI. And when we get to our fiduciary funds, we have our pension fund, we have our agency fund, our private purpose trust fund, and our investment trust fund. Now notice, even though we have not written in here, we need to remember that when we're down here at the fund level, okay, when we're down here at the fund level, we want to remember that we are having a fiscal accountability focus. Okay, fiscal accountability focus, and I'm trying to write with my pen, but I don't seem to be getting the pen the way I want it. Let me try this again. We're going to have what type of accounting at the fund level? I think it'll let me write this time. Fiscal accountability. Okay. So we're going to have fiscal accountability focus when we're at the fund level. That's for all the funds now. All the funds here have a fiscal accountability focus. Now we're also going to have information, as we've said, at the government-wide level. Okay, and when we're up at the government-wide level, we are using an operational accountability focus. And remember that when we're up here at the fund level, we are using our full accrual accounting, okay, using full accrual accounting, economic resources measurement focus, okay, and that's both for our balance sheet and our income statement, although we call it statement of net position, and our statement of activities, we're using full accrual accounting economic resources measurement focus, which is the same type of accounting that is used for our proprietary funds. The only funds that use something that is different than the proprietary and the fiduciary funds are governmental funds. Remember, I saw that on a previous slide, modified accrual accounting, current financial resources measurement focus. And so since it's current financial resources measurement focus, there is no fixed assets and there is no long-term debt. Now, remember, we're up here with our operational accountability focus as our government-wide statements, and when we are looking at those, we're going to see that we are going to have our individual funds which will get rolled up and consolidated at that government-wide level. So let's just go ahead and see what that would look like. And so we're going to pick up all of our GRASP funds. I'm going to use blue for that. We'd pick up all of our GRASP funds and we would go ahead and consolidate those into the governmental activities column on our government-wide statements. Remember, the government-wide statements are consolidation of all the individual funds. We will also pick up our internal service fund. Remember, our internal service fund is really funds, for example, for the general fund. Okay. If we have fire and police vehicles that are going to be worked on in a central motor pool, we would bring those all to that internal service fund, and we would roll that up under the governmental activities column at the government-wide level. Now, when we get to our enterprise funds, let's go ahead and circle those, and the enterprise funds show up in the business type activity column here at the government-wide level. And so we report information both in our governmental activities, and I'm not sure why this thing mentions governmental activities twice. We only show them once on our statements, but we'd have governmental activities, and we would have our and the internal service fund would go with the governmental activities here. I'm just pointing that twice because they put those twice there. But on our government-wide statements, we'd have governmental activities and business type activities. Our GRAS funds plus our internal service fund shows up under the governmental activities column, and then our enterprise funds show up at the business type activity at our government-wide level. Remember, we kept saying, where's our PAPI? Our PAPI statements, what? We can put a little X there just so we remember. Those are not reported at the government-wide level, not reported at the government-wide level. So this is a pretty nice little slide. I think it gives you the mnemonic, tells you the categories of funds, governmental funds, proprietary funds, fiduciary funds, gives you the mnemonic, gives you what? General fund, special revenue fund, debt service fund, capital project fund, permanent fund, our governmental funds. Two proprietary funds, we have what? Internal service fund, enterprise fund, fiduciary funds, pension fund, agency fund, private purpose trust fund, investment trust fund, giving us the mnemonic GRASP, C, PAPI. It tells you that the governmental funds use modified accrual accounting, current financial resources measurement focus. So under those accounting and focus, we are not going to have any fixed assets, and we're going to be learning more about our budget and our encumbrances a little bit later, but those terms are something we'll get more into in Chapter 3. Everybody else, the government-wide and the proprietary and fiduciary funds use what? Use full accrual accounting, economic resources measurement focus. And then when we're talking about our accountability at the fund level, it's fiscal, government-wide level, it's operational. And then we need to remember that we don't report our fiduciary funds at the government-wide level. However, we do report the other funds at the government-wide level, taking our GRAS funds plus our internal service fund, reporting that under governmental activities. Enterprise funds are reported under business type activity. And again, you have the mnemonic GRASP, C, PAPI to help you remember all of the funds, what categories they fall into, and the type of accounting they use. Remember, we talked in our first chapter about how the government will display its financial reporting, and we really left off in Chapter 1 talking about the CAFR a little bit. And remember, we had that financial section of the CAFR, which had in the financial section this basic information that we have to provide. And even though the CAFR wasn't providing this information was required. And so we can see that we are going to have our management discussion and analysis. That is required supplemental information. We're going to have our basic financial statements. Okay, and we talked about this quite a bit in Chapter 1. And then we're going to have our required supplemental information other than the MD&A. So obviously this information is RSI as well. Now remember, we said required means obviously you have to provide it. Supplemental means it supplements something else. And if the only other thing up here is the basic financial statements, then obviously the information that we're reporting in the MD&A, I don't know how obvious it is, but I just want to point out here that the information that we're reporting in the MD&A and the required supplemental information other than the MD&A, all of that is financial in nature. And we're going to take a look at examples of some of the stuff that falls into these categories a little bit later. Taking a look at our basic financial statements, again, we've said several times now, government-wide statements. Fund financial statements, that back and forth arrow shows that those are related. Again, our government-wide statements are consolidation of our governmental funds and proprietary funds into the governmental activities and the business type activities. Our PAPI funds are not consolidated, as we just saw. And then, of course, the notes are always considered an integral part of financial statements. Okay, so let's go ahead and start to understand more about the pieces of that basic model, starting with the MD&A. And when we look at the MD&A, it's going to provide an opportunity for this government to provide information about financial aspects of this government. So again, it is talking about financial position, talking about financial operations. So they're really going to do what? They're going to highlight the balance sheet, although we call that a statement of net positions for government, and they're going to be highlighting the financial operations, the income statement. Now they're not going to repeat everything that's in the statements. If users want the details, they can look at the statements themselves, but they will be providing information that analyzes information that's reported on the balance sheet, the statement of net position, and the income statement. The statement of activities is what we call that at the government-wide level. There's also information about economic conditions and outlook. Okay, and so the government is going to look into the future and really give a sense as to what's going on with the economy, the budget for the government, etc. I lifted this one from the state of California, and when I did, it was a while back in 2007, 2009, and you can see that at that point in time, there was a little bit of a sad story going on in that, you know, the economy wasn't doing so well, and so, you know, there was a lot of concern, etc. at that time. I'll put a sad face here. Now, what's happened? Things have improved since then, but at that time, you know, I guess they were talking about it improving. Now, you know, things are a little bit better if we're looking now. They talk about the housing market being depressed at that time and remaining depressed. Prices have snapped back pretty good in California. But you can see the nature, the takeaway here is not the specifics as to what's going on in California, but the nature of the type of things that are being included in these discussions, in the management discussion and analysis. Okay, let's go ahead and take a look at the two financial statements that are reported at the government-wide level. We have the balance sheet. Okay, that's a B. We have the balance sheet and we have the income statement. Okay, we call the income statement the statement of net position. We call the balance sheet the statement of net position. We call the income statement the statement of activities. So let's take a look at these, and we're going to see that we're going to be preparing these, as we've said, on full accrual accounting basis, okay, using the economic resources focus. We're going to provide information about, and remember we talked about the primary government in Chapter 1 and the criteria for that, and there's our two columns, our governmental activities and our business type activities. So we have these two columns that we're going to be showing. And remember, we have said that the internal service fund is reported under governmental activities, and we've mentioned that now a couple of times, the why being what? That most of the customers of the internal service fund are the other governmental funds. So even though the internal service fund is a proprietary fund at the individual fund level, we report it under governmental activities at the government-wide level. Fiduciary activities, as we've said, are not reported at the government-wide level, and we just reviewed that in Chapter 1. We just saw that in our Chapter 2 discussion a little while ago. Why? Well, the focus of the individual funds is our fiscal accountability focus. Fiscal accountability focus meaning, are we properly administering our fiduciary duty over the spending of those funds? So for the fiduciary funds, it makes sense that we would report those funds at fiscal accountability. When we get to the operational accountability focus, that's looking at how effective, how efficient we are at providing government services, and we therefore do not report those at the government-wide level because we're not in charge. We're in charge of those assets, but we don't own those assets. So in terms of our efficiency, effectiveness, the fiduciary funds do not have bearing, so they aren't reported at the operational accountability level. They are reported at the fiscal accountability level for our funds, and so we include them there. We do not include them at the government-wide level. Okay, so let's go ahead and take a look at our statement of net position. Okay, what we're really trying to take away from this slide is how is this statement going to be displayed. Okay, the key takeaway is the display of the information here, and we have our statement of net position. Of course, we know that that's our government-wide statement. Okay, that's a government-wide statement. Just put government-wide. Okay, and then we have our balance sheet over here. Now, balance sheet is what we call our balance sheet, right, at the governmental fund level. Now, this is just our governmental funds. This is not our fiduciary funds. This is our government, not our proprietary funds. This is just our governmental funds. They call it a balance sheet, and the only reason we're providing both of them here is for comparison purposes. Okay, we're going to be talking and taking a close look in a couple minutes at some sample financial statements for our government-wide statements. Okay, but notice for full accrual accounting, we're going to be reporting all assets, and I want to get the highlighter back. We're going to be reporting all assets. Okay, we're under full accrual accounting. We're going to be providing all liabilities, full accrual accounting. Now, the way we're displaying this is assets minus liabilities, and then the liabilities is going to equal our net position. Notice that on our governmental funds, again, it's just current assets. There are no non-current items. It is just current liabilities, current assets, current liabilities, and they're showing that the current assets are going to be equal. Okay, current assets are going to be equal. Let me turn this back into the pen so that we get a little finer print here. Our current assets will be equal. Get the right color. Okay, let me change that to red so we can get the red here. Our current assets are going to be equal, easy for me to write, equal to our current liabilities plus our fund balance. Okay, plus our fund balance. And remember, we've said that our fund balance is like, L-I-K-E, like retained earnings, just like our net position is like RE, retained earnings. Okay, we don't have stock in the government, etc. So our equity is really down to our retained earnings. Now, if you notice, the approach that we take for our balance sheet to presenting is what? Assets. That says assets equal liabilities plus, and I'm just going to call it stockholders' equity, even though our fund balance is like retained earnings. But the approach we take is what our, now it's just our current assets, but assets equal liabilities, just our current liabilities. But still, we say assets are equal to liabilities plus, and again, it's fund balance, and that's like our stockholders' equity, but the setup is showing that equation that we're all well familiar with, assets equal liabilities plus stockholders' equity. When we're at our government-wide level, notice we're going to sit here and we're going to set it up a little differently, which I'm sure you can understand easily, that assets, and again, since we're back under full accrual accounting, and indeed is our current and non-current assets, assets minus liabilities minus our liabilities now equals stockholders' equity. Okay, you see how they've shown that more as a difference, right? They're taking their assets, they're subtracting the liabilities here, and that difference is our net position, which is like a retained earnings. So only thing that's important here at this point of the takeaway is the way we have presented this, okay, which is what our governmental funds use the tried and true assets equal liabilities plus stockholders equity approach, current assets equal current liabilities plus fund balance. And then when we're on our government-wide statement of net position, we focus on the difference, assets minus liabilities equals stockholders equity. But of course, we call them what we call them. And the reason we're saying all assets is because it's both current and non-current assets minus current and non-current liabilities. And that difference is retained earnings. So it's just the presentation is the difference. Now, you're probably saying, okay, that's great, John, but what in the heck are these deferred inflow and deferred outflow things? Okay, what are those? So when we talk about deferred outflows, deferred inflows, okay, the way to think about these, deferred outflow is sort of like a prepaid. You pay money now and you have a benefit later, but GASB, the Governmental Accounting Standards Board, has looked at certain items and say, well, they don't quite meet the definition of an asset, yet the government has already sacrificed a resource like cash, and there'll be some benefit later, but it's not fully an asset, and so we will report it next to the assets, but call it deferred outflows. We have these deferred inflows down here. Okay, deferred inflows are items that are different than a liability. For example, if a government receives resources in advance of having earned those as a revenue, and they haven't met eligibility nor time requirements yet, that is a true liability. That is called an unearned revenue. Now, you can't call it deferred revenue because the deferred word is saved for items that meet the criteria of a deferred inflow. Okay, so you have an unearned revenue, that's a liability. But as you move along and you start to meet now your eligibility requirements, you can go from an unearned revenue to a deferred inflow as you now meet the time requirements. So let's say a government gets a grant and they have to have certain enrollment levels in the schools in order to have met the eligibility requirements, and they have to use that grant over 3 years. So what do we have? We have an eligibility and we have a time requirement. As the government, as the school district, let's say, meets those eligibility requirements because of enrollment, those funds that were unearned revenue can come in and go into the deferred inflow category. And then as that time requirement passes and they go through the next 3 years, they can take those out of deferred inflow into revenue. Okay, now, that's a lot of detail here, and we're not quite ready to fully understand deferred outflows, deferred inflows. So again, the takeaway from this slide is nothing more than the presentation, okay? Which is what? If we're dealing with our governmental fund balance sheets, it's current assets plus the deferred outflows equals current liabilities plus the deferred inflow plus fund balance, and we simply show the outflows up with the assets because they are trying to become assets. We show the deferred inflows down with the liabilities because they're a little higher on the food chain than a liability and they are trying to become a revenue. Okay, and just take the only takeaway here is the presentation, just to help you a little bit. Okay, so just to help us to visualize how those deferred inflows work a little bit, and again, when we get into our revenue recognition chapter in chapter 4, we're going to spend quite a bit of time with this, but just to take a look at how this is working here, we have our our liability, our revenue collected in advance. Okay, and this is the case when we have not met eligibility. Now I say eligibility nor time are met, but really it's the fact that we are not yet eligible for these funds that have come in. They've given us the money, but we haven't met the enrollment amounts yet. And if that's the case, we're like this little caterpillar down here that is someday hoping to be a butterfly, but not yet because it hasn't met the eligibility requirements. Then what? As we start to meet our eligibility requirements, now we have to consider our time requirements. So now the caterpillar is sitting here in this cocoon and it is waiting for time to pass, and as it has met eligibility, is waiting for time to pass, now it becomes a deferred inflow. So it's moved up from the liabilities, but it's still close to a liability. So that's why we report them down in the liabilities section on our balance sheet and on our statement of net position if we're reporting this at the government-wide level. And then as we meet the time requirements, let's say as that grant is now being used over that 3-year period that we talked about in our little example, we go from our cocoon to a butterfly. Now we are a revenue. Okay, so when we haven't met eligibility, we're still a liability. As we meet eligibility, but we still have a time requirement that we have to meet, we go to a deferred inflow, and then when we have met both eligibility and time, we go to a revenue and we become the revenue butterfly. Okay, again, takeaway at this point, guys, we're going to hit on this several times. Takeaway on this is, where are these items displayed? Deferred inflow is down with the liabilities. Deferred outflow is up with the assets. Okay, so let's go ahead and let's take a look at our statement of net position. Okay, and as we've said, the statement of net position is like our balance sheet at the government-wide level. And remember, we are going to show our governmental activities. Okay, governmental activities are going to be our GRASP funds, SPP, Debt Service Fund, the Capital Project Fund, the Permanent Fund. So we have our GRASP funds there. And remember, we've said that we're going to take our Internal Service Fund. Okay, I'm going to put an I there just so we remember it's Internal Service Fund, but that was the S and C PAPI. And that all gets reported in the governmental activities. Business type activities, there they are. That's going to have our enterprise funds. Remember, we talked about at the end of chapter 1, our component units are reported. Full accrual accounting, so we're going to have capital assets, we're going to have non-current liabilities. Okay, and then of course the difference between our assets and our liabilities, just going over to the next slide here, is going to be our net position. Remember, we said that net position is L-I-K-E, like retained earnings. Like retained earnings. And then remember, we have 3 categories of our net position: restricted, unrestricted, and invested in capital assets net of related debt. And so we have our net investment in capital assets. And remember, last time I reminded you of the mnemonic RUN to help you remember the categories of our net position. But this is our government-wide statement, and remember last time we did some practice here to see how that could be then the total net position could then be tied up to the net position that is reported for our enterprise funds. And I think we had parking and water and sewer together, that we then added those 2 together and saw that that totaled this $1,835,000 reported at the government-wide level by adding up the individual enterprise funds. Remember, the statement of net position, government-wide statement, is a consolidated statement. So that's our balance sheet. We call it our statement of net position. Going over to the next slide, you can see that we have our statement of activities. Now, our statement of activities is like the income statement, but we don't call it that. We call it the statement of activities, okay? But it's like our income statement, okay, like IS, okay? And what happens? you can sit here and we start talking about functions and programs. Functions and programs are things the government does. Okay, for example, public safety. The government tries to keep you safe, and if you make it home tonight, then the government succeeded in its function program of keeping you safe. Notice that we report our primary government. Okay, we report our governmental activities. We report our business type activities, okay, and then we have information for component units as well. So similar construction for our statement of activities that we've been looking at for our statement of net position. Now this government doesn't get very far, and it immediately starts reporting its expenses. And this government spent $1,025,000 on public safety. Now what happens? Notice we have program revenues here. And what these program revenues do is help this government defray the cost of its public safety and frankly all its programs, but we're focusing on public safety here. So this government rose $78,000 in a charge for service. Now how could they get $78,000 in a charge for service for public safety? Would the police come to your house and say, if you want us to help you, you have to pay us first? Well, not quite. This charge for service, okay, is going to be an exchange revenue. You pay and you get the service. So what happens? Let's say you decide that you're going to have a parade to celebrate, graduating from college or something, and you want to have a parade. Well, what happens? You would have to first go to the police and get a license for that parade so they could provide the appropriate protection, traffic services, etc. That permit would be a program revenue that would come in to defray the cost of the public safety program and would come in as a charge for service program revenue that is helping to pay for the public safety expenses. So they defray the cost. So they also could have operating grants, capital grants. Now for these, I want you to go ahead and put off to the side here somewhere that these are non-exchange. Okay, these are non-exchange. And in this case, the government is earning a revenue, but it's not expected that it's going to give a service right back in exchange for that service, unlike when you pay for the police protection for the parade and you then get that permit. Here, we're going to have money coming into the government, but it is not expected that it'll get a service immediately back. For example, and notice we have both operating grants and capital grants. For example, a government could apply for a program at the federal level. It's called the COPS program. It was put into place by the Clinton administration, in which a state or local government could receive, really local governments with police functions, public safety functions, could receive a grant from the federal government to pay for police salaries, police uniforms, that would be an operating grant, or to pay for equipment such as the necessary computing equipment to tap into the national database of fingerprints at the time, and now it's this CODIS database that has information about DNA, etc. But all of this is being brought in by police function, and so this falls under public safety. And so when they get this money, their operating grant, capital grant, this government in this example didn't get any, but they could have. That money is coming in as a money that is helping to defray the public safety function. So we've got exchange, we've got non-exchange. Now I'm going to show you a way to remember these later, but you could go ahead and put an SOC on these. You're going to sock these away, and I'll show you where to write that elsewhere in our outline when we get there later. But those are our program revenues. They help defray the cost of these programs. Now look, they're helping defray the cost of all these government programs, but if you look, all of these programs show a negative amount net expenses. All of these programs essentially lost money, didn't they? Okay, so remember, we're on the statement of activities. This is like our income statement. We've got our expenses, we got our program revenues that are trying to defray the cost, our exchange charge for services, our non-exchange operating grants, capital grants. But as you go over and take a look at the next slide, notice that at the bottom of our statement of activities, which is like our income statement, we have our general revenue, which are mostly taxes down here. And these taxes do what? They help to pay for the programs. And so when you look, we had all of these taxes came in that helped pay for all those programs that were showing net expenses up there. And we are left with and remember, change in net position is like our net income. Okay, we don't call it net income, but it's like net income. Okay, it's like our net income. We call it change in net position. And so this government had 794,500 that was left over. So if you think about this statement of activities, it's really an upside down income statement. Expenses at the top, to the extent that program revenues help to defray some of the cost of those, our charge for services, our operating grants, our capital grants, fine. Most programs still end up with a net expenses with essentially a loss, but then what? Then of course we have taxes that pay for all of those programs. So this sort of upside down approach to the income statement makes it clear to you how your taxes went to pay for various government programs. Okay, so going over to the next slide now. First, we looked at that statement, and I wanted to take the time to look at that statement of activities first because I think it helps us to follow a little bit better now some of the information that's on the slides here. So as we take a look at our statement of activities, of course, we saw our revenues, and our revenues were either program revenues or we had what? The general revenues that were down at the bottom. Those were mostly going to be taxes. And remember, those were reported what? At the bottom of the statement of activities, we had our function and program revenue, our program revenues really being reported by function. Remember, public safety. Then what? Then we had our program revenues and we had charge for services. Remember that charge for service was like an exchange revenue for us. Okay, so let me see if I can get my pen back. So that was, and I think we did the mnemonic SOC. We're going to sock those away. Charge for service was exchange. That was exchange. Just write that in. Was an exchange revenue. Operating grants and capital grants were what? Were non-exchange. And we gave the example of the COPS program there where they could have gotten money both for police salaries and operating and then different types of equipment. I think now under that COPS program, governments can even get money to purchase drones and stuff like that. But that's an example where they would have gotten some money under capital grant. Going over, those were our program revenues, and those were used to defray the cost of our programs, right? You can remember those by that mnemonic SOC. And then we had our net expenses, and I think for public safety, remember we said we had all those loser programs. I think it was something like 982,000 that they had lost, but then as we saw, our general taxes are going to come in and help pay for all that, right? And so we had that upside down approach to the income statement. But we call that, by the way, again, don't forget, we call that statement of activities, right? We don't call it the income statement. It's like the income statement, we call it statement of activities. And that's our government-wide statement, two of them. Statement of net position, like the balance sheet, government for the government-wide level, statement of activities, like the income statement. Okay, and then again, we had the general revenues, and remember, most of that was taxes that came in, property taxes, etc. And we saw that that was in the lower section. Okay, we're starting to repeat ourselves a little bit now. We've seen that now in a couple slides. Okay, when we saw our expenses, again, those were reported by function. For example, we followed through public safety. I think originally they spent 1,025,000, I think it was, that we followed through when we were following through, and then we started seeing the program revenues. We had that 78,000, etc., right? Okay, good. So let's go ahead and let's take a look at an example of a question that, and remember what we're doing is we're embedding the questions now in with the slides. So you'll have your quiz questions that we're going to go through together in class, but I'm also going to be putting some into the slides so we can work on these together as well as part and parcel of the lecture. So if we're at the statement of activities, we know that's a government-wide statement, and we know that when we're at the government-wide level, we have what type of accountability? Operational accountability. Fiscal accountability, C, which is the incorrect answer here, is for our fund financial statements, right? That's when we're using fiscal accountability focus. And these others, I don't know, these are just basically nonsense, okay? And so we have fiscal for our fund level, operational accountability for our two government-wide statements. This question was asking about statement of activities, but it could would also be for our statement of net position, which is like our balance sheet. Okay, good. Now, that's our government-wide statements. Now let's start to talk about our fund statements, and we're going to talk about them in our three categories: governmental funds, proprietary funds, fiduciary funds. Remember, we have 5 governmental funds: our GRAS funds, GRSPP. We're pronouncing that GRAS for our mnemonic. Then we have what? We have our 2 proprietary funds, which is our internal service fund and our enterprise fund. And then we have our fiduciary funds. We have 4 of those are PAPI funds. P-A-P-I. Okay, and all we're looking at here is the names of the statements. Okay, and so notice that our governmental funds and our fiduciary funds each prepare 2 financial statements. The fiduciary funds produce 3 financial statements. The fiduciary 2, proprietary 3, governmental 2. Okay, and we're just looking at the names of the statements here. So in our governmental funds, we have a balance sheet, which is of course like our balance sheet, and then we have a statement of revenues, expenditures, and changes in fund balance, which is like our income statement, but we don't call it that. We call it a statement of revenues, expenditures, and change in fund balance. At the proprietary fund level, we have a statement of net position, which is like the balance sheet, which by the way is the same name as I'm sure you recall that we called our balance sheet at the government-wide level. Okay, and remember we're under full accrual accounting here for our proprietary funds, and so it's not too surprising that it uses the same name as our full accrual accounting statement of net position at the government-wide level. Okay, that's like the balance sheet. Then we have our statement of revenues, expenses, and changes in net position. That's like the income statement. And then we're going to have a statement of cash flows, okay? And only the proprietary funds prepare a statement of cash flows. And we're going to see that it's similar, but there are important differences to the statement of cash flows for our governmental units, and for our proprietary funds, our enterprise fund and our internal service fund, and we'll get into that more in chapter 7. Okay, we're going to talk about that a little bit more in chapter 7, but they're the only ones that prepared the third statement, the statement of cash flows. When we get to our fiduciary fund statements, we're back to 2 statements: our statement of fiduciary net position, which is like the balance sheet, and then our statement of changes in fiduciary net position. And when you start seeing the word change in there, you are pretty much sure you're talking about the thing that is like the income statement. Okay, all right, so that's just the name of the statements for our various fund financial statements. We've looked at the government-wide. Now we're going to focus a little bit on the individual fund statements. So let's just go ahead and let's a look at our governmental funds, and just a reminder, we're using the current financial resources measurement focus. There'll be no non-current liabilities, no non-current assets. Our modified accrual accounting is what we're going to be using, and of course when we're at the fund level, we're always using fiscal accountability. Okay, so what happens, you come over and you take a look, and capital assets and long-term liabilities are not recorded. Remember, when we purchase equipment, we treat that as an expenditure, and we're going to talk about how we would treat the issuance of long-term debt here in a little while. But for our capital assets, there's no capital assets, and if there's no capital assets, what else do we have no of? No depreciation. Right? If you don't have a capital asset, there's nothing to depreciate, so we will not report depreciation on our statement of revenues, expenditures, and changes in fund balance for our governmental funds. So there's no capital assets, no depreciation. Now, sometimes I'll get students to say, well, then where will we report the capital assets? We'll report them at the government-wide level. We do not report them for our governmental funds at the individual fund level. For our proprietary funds, for our fiduciary funds that use full accrual accounting, yes, we will have our capital assets, our long-term liabilities. But right now, we're talking about the governmental funds, and when we're talking about the governmental funds, we take the approach of current financial resources measurement focus, modified accrual accounting, meaning no capital assets, no long-term debt, and therefore there's no depreciation. We're going to be working with this a lot more as we go through the other chapters, but we really need to make sure we're clear on this factor about no capital assets, no long-term liabilities at this point. Okay, now you come over, and we already went through this previously. Remember, when we're dealing with the governmental fund balance sheet, we take the approach, and we've already said we're sort of looking at that as assets equal what? Liabilities plus our stockholders' equity is sort of how we're setting that up. But we, of course, only have current assets and current liabilities, and we call our stockholders' equity fund balance. And remember, stockholders' equity, now we've said about 50 times, right, is like retained earnings. Okay. And then remember, when we're dealing with our statement of net position, which is at our government-wide level, we take the approach of assets minus liabilities equals stockholders' equity. But of course, we don't have stock in the government, so we don't call it stockholders' equity. We call it net position, and it's more like retained earnings. I think you're getting tired of hearing that. Okay, and then we talked about our deferred outflows and inflows a little while ago. Okay, so just remembering the structure as to how we're going to present our governmental fund balance sheet. And so you come over, here's our governmental fund balance sheet. This is for our governmental funds, our balance sheet. There's our buddy, the general fund. And we have current assets, right? Those are all current assets. Inventory is a current asset, right? 55,000 for inventory there. All of these are current assets. Cash is a current asset. And then it's what? Current liabilities. Okay, remember we're reporting our deferred inflows down here with our liabilities as they're trying to become revenues. And then what? Then we come over to the next slide to finish off our statement of our balance sheet, and we call it a balance sheet for the governmental funds. And here's our fund balance. Fund balance is like retained earnings, isn't it? Okay, fund balance is like retained earnings. Now notice we display our fund balance in order of how difficult they are to spend. So if you take a look, remember we saw inventory up there, our current asset inventory 55,000, and notice we sit here and we show a non-spendable fund balance for inventory of 55,000. What are we doing? We're showing that this portion of our fund balance. Remember, our fund balance is like the equity of the difference between our assets and our stockholders, our assets and our liabilities, although we present it assets equal liabilities plus fund balance. But we're showing that this portion we can't spend as cash because it's in inventory status now. And so there'll always be a matching between the amount of inventory that we show and the amount of fund balance that is sitting in inventory, that 55,000 matched. Okay, so what we're seeing here is that for the government, they break out their fund balance in categories. One is non-spendable, two is restricted, three is committed, 4 is assigned, and 5 is unassigned. And when we list these, we're listing them in terms of most difficult to spend. You can just write most difficult to spend. We don't have to put to spend, but just put most difficult. Versus easiest. So the most difficult to spend, no surprise, is the what? The non-spendable. The easiest to spend, okay, the easiest to spend is going to be my unassigned fund balance. So we have our different categories here. And let's just go over to the next slide now and start to understand what these different levels of constraint mean. And so you come over and you start to look at the categories, for example, starting with our non-spendable, okay, and this is the most difficult to spend. Okay, most difficult to spend obviously is our what? Is our non-spendable, and we give you the example here, which is inventory. Okay, inventory. You can't spend inventory like cash. Try it sometime. Go over to Costco and buy a 50-pound sack of nutmeg, and then you realize you'll never use all that nutmeg, and so you put it into a 10-pound bag, and you say, hey, you go over to Safeway and you say, will you please give me some milk in exchange for this nutmeg? What's going to happen? Safeway is going to tell you no, you can't spend that like cash, right? So when we're dealing with our non-spendable items, we can't spend those, and you can put down that these items are not cash, not receivables. Okay, receivables, you say, well, how would you spend receivable? Well, look, they're going to be cash pretty soon, and then we can spend them like cash, right? But our non-spendable fund balance is going to be not cash, not receivable, and most difficult to spend. Okay, so what we're trying to show with these categories of fund balance is how difficult it is to spend them. Just like if we're sitting here and we were dealing with a commercial enterprise and we had some cash that we decided to restrict for some purpose, we would do what? We would go ahead and debit our unappropriated retained earnings. Unappropriated retained earnings, we would debit that. And we would credit what? We would credit the appropriated retained earnings, to show that there was a constraint, that we've restricted the cash somehow, right? And I guess just to complete the thought over here, we of course would do what? We would debit the restricted cash. We can just write this up here. We would debit the restricted cash for whatever that amount was, and we probably don't have a category of unrestricted cash. We just call that cash, but we would credit the cash, and that would be showing that we had restricted that cash for, say, some long-term purpose, like to purchase equipment or something, and we want to show our stockholders don't plan on getting any dividends out of the unappropriated retained earnings. We're setting that aside for some purpose. Well, the government does the same thing, right? Only they, instead of having two categories, appropriated and unappropriated, we have these 5 categories, and we list them in order of difficulty to spend. Most difficult to spend is hello, obviously the non-spendable. Inventory is a classic example of that. Now you come over, and the next category that and we're going from hardest to spend to easiest is restricted. Okay. Now when we have a restricted fund balance, that means that there is some sort of external restriction. There's an external restriction on those funds. Okay. And so what's happening here? Let's say we issue bonds and we tell the bondholders that we're going to use that money to build a county courthouse. When we issue the bonds, we'll get the cash in, and we will have to show that that portion of our fund balance is restricted by creditors, bondholders. Okay, so that's going to be shown as restricted because we have a very limited ability to spend that money. We must spend it, in this example, on that county courthouse. Now notice they also mention enabling legislation, and you say, well, how, John, is that external if it's the legislature that has passed a law that says how we're going to spend that money? Well, the key word here is enabling. Okay, and what happens here? Use state disability insurance fund, the SDI money that they take from your check. The law that allows them to take that from your check also said that that money must be used to fund the state disability insurance fund. So what happens? They pass the law, and the law that allows them to even raise that money tells them how to use that money. We're looking at as similar to an external constraint, and we will go ahead and classify those funds as being restricted in our fund balance. Okay, so if enabling legislation, the same law that allowed them to take that money also directs them how to use it, then we consider that money to be restricted. Now you take a look and at the next slide, and we have now our committed amounts. Okay, remember, before we go to that, remember for restricted, it's going to be what? Bondholders, but also what? Enabling legislation. Okay, now you come over, or the grant provider, whoever gives us the money, directs us specifically how to use it. That money's restricted. Okay, now you come over to the next slide. Remember, we're going from most difficult to spend to a little easier to spend. Committed is easier to spend than restricted. And now we say that the highest decision-making authority of the government has decided how those monies will be used. They have earmarked those funds to be used for a particular purpose. For example, let's say we are facing some budget constraints and somebody suggests that we cut out school sports. Then what? Then the legislature looks at that and says, well, wait a minute. We have a pot of funds that we have raised through the sale of football game ticket revenue. Why don't we use that money for our, high school ticket money, whatever? Why don't we use that money to fund school sports? So what do? They earmark that money for that purpose. Now, that's the legislature taking an action, just like the legislature took the action in enabling legislation. The difference is that in the case of this football game money, we already had those funds available, and we are simply earmarking them for a specific purpose. That money would then be committed because the legislature would have to go back and vote again to remove that constraint off of those funds, and so they can't be moved around by the government managers, the managers of the various programs themselves. It's the legislature that has to do it. Now you're saying, John, but they could change their mind on the enabling legislation. Yeah, but if they do that, they might also remove the ability to get the revenue to begin with, and so that money is going to be considered restricted versus here we're taking funds we already had and we consider those committed. The other question I get sometimes, you say, well, why do you say the highest decision-making authority? Isn't the mayor the highest decision? Isn't the president the highest decision-making authority? When it comes to spending money, we consider the legislatures to be the highest decision-making authority. Again, we're not studying federal government accounting in here, but at the federal level, it would be what? The Congress. At the state level, state of California, we call that the state legislature, and that's typically what it's called at the state level. If we're talking about a city, we're talking about what? The city council, right? And we consider that the highest decision-making authority when it comes to spending of funds. Okay, our next category is assigned. Okay, and for assigned, I want you to go ahead and put program managers. Okay, so what happens? We give our program managers, we tell them, okay, you have funds to run the program. Say we give some money to our park and recreation department to take care of the parks in the city. And so they sit there and they say, all right, we're going to buy a jungle gym set for every single one of the parks in the city, right? And they're going to put that money aside to do that. They were given money, has to be used in parks and recreation, but now the individuals that run that program, okay, those program managers have decided how they're going to use those funds, and they're going to put a jungle gym. Then somebody looks and says, wait a minute, all the sprinklers in the park, they're damaged and they need to be fixed, or the parks are going to all, of course, with the drought in California, that might be a good thing, but just continuing on with that example, we have to fix all the sprinklers in the park, right? So what happens? Now the program managers can change their mind and say, well, we were going to spend the money on jungle gyms. Now we're going to have to go ahead and spend that money on the sprinklers. So when we deal with this, we are really signaling our intent to spend the money, and this is at the program manager level, and they can do what? They can go ahead and change their mind if they need to. So unlike the committed funds, we do not go back to the highest decision-making authority. We can decide that at the program manager level. Okay, and then finally, you come over and we have our unassigned. And if we're dealing with our unassigned fund balance, that means that we can spend it however we see fit within, of course, the constraints of the program and whatever the appropriate use of that money was when it was first given to us. So we can't all of a sudden use money that's for, I don't know, sanitation and start using it for parties, whatever. Again, you know, we have to stay within the constraint of the appropriation, but within that, we can use it however we see fit. So that money is going to be considered unassigned. Now, what happens? The general fund is the only fund that can have a positive unassigned fund balance. All the other funds are going to, if they have an unassigned, it's going to be a negative amount. Now, what does that mean? Well, you sit here and let's say you have a capital project fund. Let's just use this as an example. Capital project fund. And let's say they've issued some bonds to help build that county courthouse. So they have some cash. And let's say they have cash of $200,000. Okay, and I know you can't build a county courthouse for $200,000, but just humor me here for a second so our numbers don't get ridiculously big here. Okay, so we have cash of $200,000. Okay, then let's say we had some inventory. I don't know, we've got some sheetrock or nails or something, wood laying around that we can use to build this county courthouse. So we have inventory, and let's say the inventory is, I don't know, $20,000. Okay, so we've got some cash, we've got some inventory. Then what? Then, before we can really begin to construct this, we have to do an environmental impact study. They make us do environmental impact studies so that we don't destroy the environment, we don't ruin the traffic patterns, etc. around this county courthouse. So we're going to have to do an environmental impact study. And when we read the bond covenant, they say that we can only use that cash on hard costs. Hard costs are things like the blueprints, the digging the foundation, the actual construction work that's being done, bulldozers, hammers, hammering, that sort of thing. That's all we can use that $200,000 on. So what happens? Doing an environmental impact study is not a hard cost, let's say. And so we're sitting there and we're going, well, look, how can we begin this until we do the environmental impact study? So somebody says, just order the impact study, we'll get the money. So we do the study, and the environmental impact study company goes ahead and bills us for that. So now we have a liability, and let's say this thing cost us $30,000. Okay, well, how are we going to now report our fund balance? Okay, and when we report our fund balance, okay, when we report our fund balance, we'll have a what? We'll have a spendable excuse me, a non-spendable fund balance, not spendable, non-spendable, just going in order of constraint, difficulty to spend, non-spendable fund balance for the inventory, and that's going to be 20,000. Right? Because we have that inventory up there. There's always going to be a match between the inventory and the non-spendable fund balance, always. Okay. Then what? Then we will have a restricted fund balance, and that's going to be what? This 200,000 cash, right? Then what? Then we're going to have an unassigned fund balance. And this unassigned fund balance is going to be this negative 30,000, because by definition, if we're in the capital project fund, all the money is spoken for the capital project, or if we had inventory, it's inventory, and we can't use this money for anything else, so we can't use it to pay this liability for the environmental impact study, so that money has to be now unassigned at 20,000, and it's a negative unassigned. Now you're sitting there and saying, well, okay, where are they going to get this 30,000? Well, our general will pay for that. The general fund, right? The general helps us out. The general fund will probably transfer the money out of the general fund and into the capital project fund, since the general fund can have a positive unassigned fund balance. That's why they have that money up there, so that they can use it for general purposes to basically help finance activities of the other funds that they are not able to cover. And that's a lot of what the general fund does. Okay, now when we look at these categories, guys, notice we had non-spendable, right? And then what? Then we had spendable. And I'm going to give you a really, really dumb mnemonic. We had spendable Raquel, okay? Spendable Raquel. And spendable Raquel spends his money on whatever he wants. Okay, spendable Raquel. I know it's dumb, and it's so dumb that you remember it, and that's why it's good. So we had what? We had restricted, we had committed, we had assigned, and we had unassigned. Spendable Raquel. It's so dumb you can't forget it, right? Okay, so those are our categories of our fund balance, and it's trying to show how difficult or easy they are to spend. Obviously, non-spendable is the most difficult. Then we have some that are spendable, restricted, more difficult than committed, committed more difficult than assigned, unassigned, assigned more difficult than unassigned, right? Okay, good. So let's look at this exercise, okay? Because I know we give you 52 words there, and then you're like, what is happening on that? So let's just look at this example, and I think you'll see the way this works. And so we have this fire station capital project fund. We have a bond issue, and we have to use the bond issue for the construction of the firehouse. So that money is clearly what? Clearly restricted. Remember the bond issue, that money's restricted, right? Then what? Then we have funds that are being set aside by the city council, okay, for ongoing maintenance projects. When money is set aside by the city council, that's the legislature, that's the highest decision-making authority in the government. We consider that money what? Committed, right? Then what? Then you come down to this other one, and we have a library debt service fund that accumulates money to pay off debt. And we have a bond issue that says we're going to use that money to pay off bonds that are coming due. And you say, really? A government issues debt to pay off debt? Yeah, take a look at the federal government. They do that every week until they have some $19 trillion in debt, like we talked about in class the other day. But since that's a bond issue, that money is what? that money is also restricted. Okay, and if you're wondering, well, where's 1, 2, 3? That was, I took this from another exercise, and there were some things there that I didn't want to include in this example, so I just picked it up at 4, 5, and 6. Okay, let's look at another question here, and we have money that has been constrained by law through what, constitutional, or oh, there we go, the enabling legislation. That money is going to be restricted. Okay, so a couple practice problems for us there. Okay, good. And then we give you a summary here, and the key thing is down here in this last box down here, where we just remind you that what, only the general fund will have a positive unassigned fund balance. That's limited to the general fund. Okay, all right, so let's take a look at now. We've understood something about our balance sheet for our governmental funds. Let's take a look at our operating statement, our statement of revenues, expenditures, and changes in fund balance. Okay, and we take a look and we see that we're going to be understanding revenues and other financing sources, expenditures, and other financing uses. So we have two categories of things that are like revenues. Obviously, revenues are like revenues, and then we have other financing sources. Other financing sources, why don't you put like, L-I-K-E, like non-operating revenue. Okay, so these are like non-operating revenue. Okay, and then we have our expenditures, which are, of course, operating items. Revenue and expenses are operating items, right? Revenue and expenditures are operating items, but we also have other financing uses. Other financing uses are like, okay, I'm not going to put the like there again. I'll just say both of these are like non-operating expenses. Okay, good. So we've got what? We've got our revenues and other financing sources. Other financing sources are like non-operating revenue. We've got our expenditures and other financing uses. Other financing uses are like non-operating expenses. Okay, and so you come over and you take a look, and we say that other financing sources mainly represent operating transfers and proceeds from long-term borrowing. What are we talking about here? Remember, we said that there is no long-term debt reported on the balance sheet of our governmental funds. So when we issue debt, obviously we debit cash. We're not going to mess you up that much here. When we get cash, we still debit it. Say we issue bonds for, I don't know, $2 million. We're going to debit cash $2 million. We can't credit what? We can't credit bond payable here because we don't have any long-term debt. So we'll credit, and I'm going to abbreviate it OFS, other financing sources, and this is going to be for the bonds. Other financing sources, $2 million. Okay. And since this is basically like a non-operating revenue, this item is reported on the income statement. That's reported on the income statement because it's like a non-operating revenue. So something very unique to modified accrual accounting here. When you issue debt, you treat that as an other financing source. It's like a non-operating revenue, and so it's going to be reported on the income statement as an other financing source. You don't credit long-term debt. Now, we said that it also includes operating transfers in from other funds. Go back to the general fund example. Remember the general fund example where we needed some money from the general fund? So when the general fund sends that money over, in our little example, it was going to go over to the capital project fund. The capital project fund will debit cash when they received that money. And again, I guess we were saying it was $30,000 to cover that environmental impact study. And credit, what is it? Other financing sources. Now we're going to label that transfer in. Okay, transfer in, but we would credit that for $30,000, right? Okay. Again, that is reported where? That is reported, just like we said before, that's reported for the bond proceeds, that's reported on the income statement. So there's our two operating transfers, our two, I should say, other financing sources, which is what? Operating transfers, proceeds from long-term debt. I think that's a pretty good flashcard for you to say what are the two other financing sources, and it's what? It's the proceeds from long-term borrowing and what? And operating transfers in when that money comes in. Now, when we come over and we deal with other financing uses, we say that that really is what? Transfers out. So when our general fund now, looking at the other side of this transaction, transfers the money out, they will debit other financing uses. I'm going to abbreviate that OFU, other financing uses for what? For transfer out. It says transfer out, and we're going to debit that 30,000. And then we will credit cash, obviously, because that money is coming out. So we're going to go ahead and credit. I'm not sure if I said debit the cash. We're going to credit the cash for the 30,000, right? And that will get reported where? On the income statement. That OFU, transfer out, gets reported on the income statement, on the statement of revenues, expenditures, and changes in fund balance, because it is like a non-operating expense. So here's another flashcard right here. You can put flashcard, what is the one OFU? And the one OFU is what? Other financing uses is a transfer out. Okay. All right. So that sort of explains what those are all about. They're like non-operating items, other financing sources and uses. And it's very important that we understand how our revenues, our other financing sources, our expenditures, our other financing uses affect fund balance. Okay, so since fund balance is what? Fund balance is like retained earnings. Since it's like retained earnings, it's important that we realize that what? That our revenues will increase our fund balance. Our other financing sources, which are like non-operating revenues, right? Which are like non-operating revenues. Okay, so it's important that we realize that our other financing sources, which are like non-operating revenues, are going to do what? They're going to increase fund balance, right? They're going to increase fund balance. Our what? Our expenditures and our other financing uses are going to do what? Decrease fund balance, right? Because fund balance is like retained earnings. So very important that you realize that when we close these items out, just like you would close revenues and expenses to retain earnings, when you close your revenues and your expenditures, your other financing sources, which are like non-operating revenue, your other financing uses, which are like non-operating expenses, okay, that those get closed to fund balance. The revenues and the other financing sources are going to do what? They're going to increase fund balance. The expenditures and other financing uses are going to do what? They're going to decrease fund balance. Okay, very important slide. Okay, I'm going to put a star on that. You got to make sure you're clear on how those items affect fund balance, because we're going to be seeing how we'll make some closing entries later, and I'm going to expect you to understand how to make those closing entries into fund balance for your revenues, your expenditures, your other financing sources, other financing uses. Okay, so let's go ahead and let's take a look at our statement of revenues, expenditures, and changes in fund balance. This is like the income statement for our governmental funds. There's our buddy, the general fund. And you can see that we have our taxes coming in. Okay. Then what? Then we have some of our charge for services. Notice we have similar categories to what we had on the statement of activities. Remember, statement of activities is the consolidation of our governmental funds, right? Then what? Then we have our expenditures. Okay. There's, remember, public safety. So we're having a similarity into the nature of the items that are being reported on the operating statements, both at the government-wide level and the individual fund level. Difference: one is different names, obviously. One is at the government-wide level, one is at the individual fund level, of course. And then what? The statement of activities at the government-wide level is using full accrual accounting. We're using what? Modified accrual accounting here. For example, when we go ahead and we spend items on our what? On our capital items, we treat those as expenditures, right? That is something that is unique to governmental accounting, that we treat though to modified accrual accounting. It's probably more accurate to say, or more specific to say, that under modified accrual accounting, we do what? We treat those as expenditures. They show up on our statement of revenues, expenditures, and changes in fund balance, which is like our income statement. Notice here we have what? We have this item called excess of revenues over expenditures. Okay, and you could have a deficiency as well, which would be like a loss. But go ahead and take a look, and you can put down here that I can get my my pen back here. Okay. Go ahead and put here that this is like operating income. This is like operating income. Right? All the way back to your first accounting class, in which we told you what? You have your non-operating items, you have your operating items, okay? And the operating items are your revenues and your expenses, right? These are operating. Now, we don't call them that in commercial, but these, I mean in governmental, excuse me, but in commercial, we'd call our revenues and expenses our operating items. That says operating items, I think. Okay, we have our operating items. Sometimes these pens are crazy to use on the tablet. But anyway, we have our operating items. Those are our revenues and our expenses. And then the difference between those, but in our expenditures, I should say, and remember, expenditures include some weird things under modified accrual accounting, like when we purchase a fixed asset. But the difference between our revenues and our expenditures give us this excess of revenues over deficiencies. That's reported on our income statement. It's like our operating income. Make sure you're making a note of that, because I promise you I'm going to ask you a question about that on your midterm. Coming over, then we come down and we have our other financing sources and uses, and those are sort of like non-operating, right? There's our non-operating items. Okay, and when you look at those non-operating items, remember we said what? Two other financing sources are what? Our proceeds of long-term debt and our transfers in, and then we said that we only have the one other financing use, and that's going to be what? The one other financing use is going to be our transfers out here, okay? And you can see those reported there like non-operating items. Then what? Then we have our change in fund balance for the period. Change in fund balance. Remember, we said we could call our net income the change in retained earnings. We don't call it that, though. We call it net income, but our change in fund balance is like, L-I-K-E, is like our what? Net income. But we don't call it that. We call it change in fund balance. Okay. All right, good. So that gives us, I think, a pretty thorough look at our governmental fund financial statements from a generic standpoint. Of course, we have our 5 governmental funds, but that gives us a sense as to the structure for all 5 of those, the way their balance sheet will look, the way their statement of revenues, expenditures, and change in fund balance will look. And all 5 of those governmental funds will follow the same format. Okay, so that's the same format for our general fund, special revenue fund, debt service fund, capital project fund, permanent fund will all follow this format. Okay, let's go ahead and let's take a look at this slide now. And all we're talking about here is labels, classifications that can be put on our expenditures in our statement of revenues, expenditures, and change in fund balance. And we saw some of that when we were just looking at that. For example, remember I pointed out our buddy, the general fund. So obviously we're going to report our expenditures by fund, and those were the different columns that we saw on that statement of revenues, expenditures, and change in fund balance. We'd see column, for example, for our special revenue fund, for our debt service fund, etc. Okay, by the way, don't forget the A is for and to help spell grasp. Okay, then what? Then remember we saw public safety as a function. We saw that at the government-wide level, but remember I said, hey, there's similar between the government-wide level and the fund level, and so I pointed out public safety there on our statement of revenues, expenditures, and changes in fund balance. We saw that. Then what? Then we have organizational units. Organizational units are the entities that carry out our programs. So we have the fire and police department, and they carry out the public safety function. Now they have to carry on activity. For example, the fire department might do some building inspection to make sure that the building is safe, that all the fire exits are unobstructed, etc. Then what? Then we have character. Character talks about the period of benefit. Okay, and so if we say current for our expenditure, that obviously anyone can figure that out, but we put that label on there, current, that obviously means that it's going to benefit the current period, right? If we put capital, and remember I showed you that capital expenditure, even though we're calling it an expenditure, we know that it is what? It's not expired entirely in this first period. If we buy police cars, for example, they could also benefit future periods as well. Okay, then object class is really just a chart of accounts. I mean, this is what you learned in your very first accounting class, where we go ahead and list out our chart of accounts, and we include our different financial statement items under these different accounts, right? Salaries, for example. Okay. All right, now these are optional labels. They don't have to use all of these, and I think you saw how we were using some of these on the statement of revenues, expenditures, and change in fund balance when we were looking a little while ago. Okay, so let's go ahead and let's take a look here at this slide and notice that we have our journal entry in our general fund for the purchase of equipment, and notice we're treating that as expenditure, and we're putting the label capital outlay, but it's still an expenditure. If we're at the government-wide level, we would do what? We would report that same transaction now using full accrual accounting, and we would debit building. Okay, now as we go through, and that would be reported in our governmental activities column at the government-wide level, this is being reported the general fund at the individual fund level. Now as we go through the text, the slides put out by the author of the book are going to be showing this dual system where we're making an entry at the government-wide level, at the fund level, the same transaction, individual fund level, using, if we're in a governmental fund like the general fund, using modified accrual accounting, at the government-wide level using full accrual accounting. Now, what we do in reality is, instead of having two systems and making two sets of journal entries, typically we make the entries at the fund level, and then we convert the fund financial statements into the government-wide statements as we effect that consolidation. So what would we have to do? On the worksheet, we would want to turn this modified accrual entry at the fund level into a full accrual entry at the government-wide level. So we would have to do what? We would make an adjustment on the worksheet to debit building and credit expenditure, so that when we're reporting this now in our consolidation at the government-wide level, this transaction would be shown under full accrual accounting. We'd have a building and we would eliminated that expenditure. That's the way it's actually done, as opposed to this two sets of journal entries where there's two sets of books going on. You wouldn't do it that way because the chances that those sets of books will match up at the end of the year is nearly impossible. So they use a worksheet approach, and I'm going to hope that we can get MGO to come to class and show us how they would affect this. That was the basis of their presentation last time. If they're not able to come because they are in the middle of busy season, I will go through their presentation with you when we get to that, after we've gone through our chapters here on our governmental funds, after chapter 6 essentially. Okay, so that's the way that works. Okay, so you can see money coming in where we've issued bonds, or not bonds, but it's a 3-year note, long-term debt financing. So you can see that coming in as an other financing source, debit the cash, credit other financing sources. Okay, you can see that at the government-wide level, of course, using full accrual accounting, we would debit the cash, credit the note payable. And again, if we're trying to convert the individual fund statements to the government-wide statements, we would do what here? We would debit note payable and credit, to turn the individual fund statements into government-wide statements, we would debit other financing sources and credit the note payable to convert the individual fund statements under modified accrual into full accrual accounting. Again, they're talking about dual effect and showing two sets of transactions. The textbook, for some reason, believes that governments would have two sets of records. I don't think they thoroughly understood the complexities of doing that in practice, and that's why we're going to have that presentation that would show you how they do it in reality. And again, last semester we got MGO to come over and to show us how they do it as the auditors of all the big state and local governments around California. So hopefully we'll get that treat and they'll be able to come back and show us that again.